CNBC TV18, embarking on a quarter century of excellence.
Today on It's the Economy is the new rule announced by Reserve Bank. Now, let me give the background first. Reserve Bank has noticed a practice whereby banks and or NBFCs, when they find that a borrower is unable to repay, they float an AIF, invest in that AIF and lend the money of the AIF to the stressed company so that company can repay the bank or the NBFC. Now, the AIF itself redeems its units only after 6 or 7 years, so the company has enough time to turn around. Now the Reserve Bank has said, if banks and NBFCs own units in AIFs which have lent to their existing borrowers, then the banks and the NBFCs have to sell out of these units in 30 days. Alternatively, if they continue to hold the AIF units, they have to fully provide for their exposure in that ultimate borrower to whom the AIF has lent and who is their borrower as well. Now, this includes companies in which the lenders have current exposure or a loan or, have a loan in the past 12 months. Now, in some instances, the AIFs, while giving a loan to the company, to the stressed company, insist that if the company defaults, the AIF will have the first right to take out their money. This, in legal language, is called priority distribution model. In such cases, Reserve Bank says the banks or the NBFCs will have to set aside their from their capital equivalent to the investment in the AIF. So it's both a provisioning penalty and a capital penalty that Reserve Bank has announced. Joining me now is S Sriniwasan, Managing Director at Kotak Alternate Asset Management. Srini, thank you very much indeed for joining us. Well, I think what our viewers want to know is who are the casualties, who is affected. But before that, can you just explain the genesis of this problem and why SEBI and RBI are at it?
Morning, and thank you for having me on the show. I think the SEBI and RBI have acted because there are some players who have indulged in this senior-junior structure of parking their existing problem loans into an AIF. Having said that, the intent of the Reserve Bank of India's regulation is correct, i.e., you want to discourage round-tripping or evergreening of your loans. But to your question in terms of who is impacted, the short answer is the entire AIF industry is going to be damaged by this. And I will explain that in a couple of sentences. Number one, you mentioned that this particular provision is applicable only for present or past lending of the banks. But a close reading of the circular includes not just lending, but any investment by the bank. And let me explain how the industry will get impacted. Let's take, for example, NIIF, which may have received a number of investment from, let's say, a bunch of government-owned banks. Now, NIIF cannot invest in the equity of that company if any of the government-owned banks is presently a lender or has been a lender in the last 12 months, as per this circular, the way we read it. Similarly, let us look at SIDBI, for example. SIDBI is one of the largest providers of capital for venture capital and SMEs. And if SIDBI was a lender to an SME, and venture capital fund in which SIDBI is an LP cannot participate or invest in that venture capital fund. That's what the circular says. So it's not restricted to just NBFCs. The entire industry is likely to be impacted. And to be able to sell their, the banks to sell their existing units simply because there has been some exposure by a AIF in which they have invested within 30 days is going to be a very, very challenging task.
Oh, okay. SIDBI or other entities getting impacted is not a stock market problem. It is an economic problem, I agree. But let me just handle the stock market issues. Is it banks or NBFCs that are more likely to be impacted? See, AIFs are owned by the mutual funds, and that's a very small part for the listed universe. But banks and NBFCs are large in the stock market. Which do you think have gone through this route?
I think the regulators' focus was on certain NBFCs, which has done this. Obviously, I can't take any names. But clearly, wherever NBFCs have sponsored an AIF and where they have parked some of their stressed loans or about to be stressed loans, will come under the scanner. And all of you are very smart. You know what's going on in the market. So I'm sure you'll be able to find out the names of those NBFCs.
First, I must bow to your candor, Srini, because I can't tell you how many phones I tried. Of course, to be fair, several people are, on holiday. It is the holiday season. But several didn't respond, which makes me want to wonder, who are the affected parties? And these include banks and NBFCs. I'm just a little puzzled, but it's quite possible that people are holidaying. Srini, let me come to, how this will be operationalized. Now, let me assume a very good bank. Okay, let me take HDFC Bank. They own some units in Kotak's, AIFs. Now, when you give a loan to one of the companies, you have to intimate HDFC Bank. How will it work? I mean, they have no control over you. They've already invested.
That is exactly the problem. First, I will have to find from the potential investee company whether any bank who's an LP with me does have an existing lending or has had an existing lending relationship for the last 12 months before I evaluate an investment in that company. That's one part of it. Secondly, what if there was no such exposure by such bank and I start doing the evaluation? It takes me a couple of months to make an investment. And in the interim period, the bank has approved, let's say, a working capital loan to that same investee company. Again, we are in a jam. And I, without knowing that, I invest in that company. The impact is not on me as a fund. The impact is on my bank LP, who then has to sell the units of my fund immediately. This is within 30 days. So it's going to be very, very difficult to execute this.
Okay. Yeah, sell the units is one problem. At the moment, the current problem is going to be they have to provide. Now, there is a lot of
sell or provide
in the market. Yeah. No, there is a lot of hearsay in the market now, so I don't want to sound scary, but there are a bunch of people who say the real problem is provisioning. Because you cannot sell out immediately, it will be a big haircut, since there will be a lot of banks and NBFCs who want to sell. The provisioning will be huge, and probably Reserve Bank went into this now because, PSU banks have reported in FY23 1 trillion of profits. First time we have had in private banks 1.2 trillion of profits. So there is a point of view that the Reserve Bank has moved in primarily because this is a good time. They have the money to provide. Let them provide for their weak assets. So would you say that banks could also be casualties through the provisioning route?
No, some banks or NBFCs could be the casualties through the provisioning routes. And I think it's a fair provision from Reserve Bank of India's point of view, so long as the investment by the AIF was in stressed loans of the investing LP banks. But the way the circular is currently worded is it doesn't matter whether the underlying loan was stressed or not stressed, and whether, it is about any exposure by the bank who's an LP in the fund. It could be an equity exposure. It could be a debt exposure. It could be a working capital exposure also. And that is where the problem is. Suppose there is a good company which is doing very well, and the bank is an investor in a fund, and that bank is also a working capital provider to that particular company. Now that fund does a private equity transaction in that company. What this triggers is that the bank now has to sell the units of the fund.
Yes, I take your point, sir. I mean, this does look very difficult in good cases. The type 2 error.
Exactly.
Where, you're
so
hurting,
I think, a few bad eggs has put the entire industry in a mess.
Okay. Now, what size are we talking about? There are some people who talk about 80,000 crores, some people who talk about 15 to 20,000 crore. What's the size likely?
It's hard to say that, but let's just look at the macro picture and where are the checks and balances in the picture. Even today, banks are not permitted to invest more than 10% of their net worth into AIFs in aggregate. Okay. So there is an overall limitation in terms of the bank exposure to AIF in the first place, which is as per the present norms applicable to the banks. So one doesn't have currently, at least I don't have the data offhand in terms of what is the total volume of exposure of banks to AIF. But let's assume that number runs into a couple of $1 billion, a few $1 billion. Out of that, how much of that is genuine investment? For example, a bank which is an investor in, again, I come back to a fund like NIF, which is the National Infrastructure Investment Fund, right? and AIF may be doing a proper job of funding infrastructure in the country, or performing assets in the country. But just because the bank has a loan to the same infrastructure project, now the bank will have to sell its ownership of the units of the AIF, for example.
Okay. So if you're saying it's only going to be a couple of $1 billion that banks have put into AIFs, we could divide them into three categories. One part of it are people who are, conning the system. One part would be people who are actually investing for infrastructure funds, etc. And another part could be, people who are investing for private equity. So, equity related, you want to take an exposure to an unlisted stock. So that's why they're going the AIF route. So my sense is not a great deal will be, if you take out the good guys, the impact in terms of high provisioning will not be too much. Is that a fair guess?
But that is probably a fair guess. So you've got to really focus on where the problem areas are.
Okay.
And I think if you see the RBI circular, it emphasizes the fact that they have actually seen this in certain NBFCs. If I'm not mistaken, let me just read the circular.
Certain regulated entities is what I remember.
Regulated entities. It's a euphemism for that, actually.
Yeah. Okay, but just a final question. Therefore, is anybody, bank, NBFC, or FIDC or IBA or AIFs wanting to approach the regulators to refashion, tweak this?
I'm sure. Look, the industry body is already seized of the matter. And we would like to have a constructive engagement, both with the RBI as well as with SEBI, to make whatever appropriate changes are there, so that the investment environment and risk capital environment in the country is not vitiated. Otherwise, if you take out a very large component of people who are going to give capital to AIFs in India, we are essentially just not giving a great leg up to the domestic AIF capital formation agenda at all.
Fair point. But when regulators try to give elbow room, there are a few bad eggs which spoil the show. Srini, thank you very much for starting off this discussion. Please, go ahead.
I want to make one more point. It is not just few bad eggs who are managers of such AIFs. It is also adventurous interpretation of rules and regulations by advisors to such AIFs. And I want to make that point very clear. People think that they can get through these loopholes, that they think that they're too smart as advisors. And unfortunately, that creates a huge problem for the entire system. So it's not just managers.
Creative interpretation. Yes, not just managers. I'm bringing in even the other parts in the financial system. Take your point entirely, Srini. Thank you very much for kickstarting and educating us and our viewers on this very important development. We have to wrap up on Bazaar in a hurry. Chartbusters up next.
CNBC TV18, embarking on a quarter century of excellence.